Hi, everybody. My name is Shahab Kaviani, and I'm the co-founder and chief marketing officer here at Onevest. Thank you very much for joining our webinar today. We're going to go ahead and get started here. First, I'd like to just start by introducing myself. Let's see here. All right. I've been working with startups for a little over 10 years. I've co-founded a couple of startups in the past. One was a company called HyperOffice, it's a cloud collaboration software company, and I also was I am the co-founder of Co-Founders Lab, which you may know is a part of Onevest. It's a Onevest company we merged over this past summer. I've personally raised money in the past around $800,000, and I would like to be sharing with you what I've learned through that process and some of the best practices that we've collected over time and speaking with founders and investors. So today we're going to be talking about where can you find capital to fund your company. We'll go through some key terminology so you can get comfortable when speaking with investors, and whether you should even take outside capital and going through the pros and cons of that, deciding how much money you should raise, and being able to speak with investors and being able to influence them on making an investment in your company by really being keen on what they look for. And then we'll quickly talk about the state of the equity crowdfunding market, which is quickly changing in front of us, all for the better for founders. So what are some of the fundraising sources? Well, by far, I think that we're seeing mostly bootstrapped. Is really still the most popular. That's credit cards, your own money, revenue from your company. That's still the most popular way. And then we have friends and family. So getting your friends and family who believe in you as a person to execute on an idea is another source. My favorite, and I think the best source, is customers selling your product and reinvesting that revenue back into your company. Now, if you are building a high-scaling, fast-scaling startup company, you probably will need some outside capital at some point, but it is possible to do it through your own revenue. It's just going to take you a lot longer to launch. So if you are in the tech industry, you really don't have that luxury to delay that process. So outside capital becomes a more obvious choice. And then we have accelerators. These, if you are a first-time founder, this is a great option too, because in addition to getting outside capital, you'll also receive mentorship from a network of advisors that they bring in, and connections that the accelerator may have, as well as education. So there's a lot to be said about the accelerators. One of the ones that we work very closely with is TechStars, DreamIt Ventures as well. And a good starting point is checking out the Global Accelerator Network, and this is GAN, which these are vetted accelerators that you might find one in your neighborhood. And then of course angel investors that can come from angel groups, and VCs is sort of a little bit further along once you've really proven the model. We'll talk about that later. And today we're going to also talk a lot about equity crowdfunding. Onevest is an equity crowdfunding player in the market, and we'll be talking about that source, which is fantastic. And I've actually personally been successful raising money on a platform which previously was Rock the Post. Before we merged Co-Founders Lab with Rock the Post, I used the platform myself in order to do two things. One, I wanted to be able to speak intelligently about this development to my fellow founders. We have close to 40,000 entrepreneurs around the world that use Co-Founders Lab, and before I began sort of preaching the gospel that this works, I wanted to make sure that it did, and it worked great. I picked up a few investors, and it was so good that I ended up merging my company with Rock the Post to create Onevest. So it definitely works, and it's a great development in the industry for us. So where do we get money from? It's still founder savings is really where it starts, and then believe it or not, credit cards these two are by far the biggest sources. and then we kind of make our way down. It's a big drop to family and friends, and then it's continuously kind of a smaller source as far as the pie from banks, and then VCs, angels, and equity crowdfunding is so new. It doesn't really register on this chart quite yet, but we think it's getting there. So some of the key terminology you want to get familiar with is the equity, or that crowdfunding there's really two types. There's equity crowdfunding, where you're actually issuing shares of your company to the investor, and then there's other crowdfunding which is more donation based. So this is like your Kickstarter, your Indiegogos, these platforms where you are giving them, your investors, they might put in $10, they might put in $1,000, and you're giving them, T-shirts, maybe the first version of your product when it comes off the assembly line or when it's built on, it's available. They might get to, join meetings. There's all sorts of clever ways to compensate them. But what we're really talking about is equity crowdfunding. You're issuing shares, ownership of your company in exchange for an investment. The next term is getting familiar with is a cap table. What's a capitalization table, often referred to as cap table, illustrates the ownership of the company. So as money comes into the company, you over time, the existing investors get diluted, and you issue more shares, and so you represent your old investors, kind of represent a smaller and smaller share as new investors come in, and new investors want to understand who owns the company. Some things that they're looking out for is what percentage is owned by outsiders versus insiders. And in the earlier days, the more that the founders own, that's usually a good sign, because you're really motivated you have a lot at risk and a lot to gain by executing successfully on the business. You'll also be asked, what's the valuation of the company? So they're asking if you counted up all of the shares, let's say each share was 10, for round numbers, $1, and you've had 1,000 shares, the valuation would be $1,000 valuation. So they're really asking, what's the company worth? Your term sheet. So a term sheet is what a very short document. It could be as short as 1 page. I've seen them, 3, 4 pages, that essentially outlines the arrangement between you and the investor. So what is the valuation of the company? How much are they willing to invest? If it's a convertible note, when do you have to pay the money back? What's the interest rate? Do they get a board seat? All of this sort of mechanics of the investment is summarized in a term sheet. So, and when somebody says, "I'll send you over a term sheet," that's when you do a backflip and you get excited, and you're on your way, and now it's time to negotiate and close that investor. So if somebody says, "Send over a term sheet," or "I'll send over a term sheet," that's a great sign. Convertible note. So this is becoming more and more popular. I actually use convertible notes sort of very frequently at Co-Founders Lab when I was raising capital. Nice thing about convertible note is that you don't have to establish the valuation of the company. So essentially, what a convertible note is, it's a debt instrument. So I issue a note to the investor. That means I owe that investor money, and in exchange, what they're going to get is favorable terms in a future in a future equity arrangement. So let's say, for example, I issue a $500,000 debt, and in a year from now, I do a Series A. All of those note holders would convert into equity in the future, but they're getting a discount. So you basically say, whenever you guys get it's usually called a qualified financing round, and you can agree on what that amount is. Then you would agree that when that happens, that you might get, say, 25% off of the price that is established at that time. So you kind of kick the can down the road a little bit on negotiating a price, and which is good, because that could really slow things down, particularly at early stage investing, because this isn't like buying a stock or a house. There's not a lot of comparables out there. So that can be a pretty tough thing to work out. Dilution, we talked about this quickly earlier. It's essentially what occurs throughout the future rounds of financing, and it's essentially you own a smaller percentage of the pie. And your earlier investors, particularly like your lead investor, if you're raising like let's say more than 500,000, definitely when you're like at around $1 million or more, your investors your lead investor will probably require preferred shares versus common shares. So common shares is what the employees, often founders, have, and then when you have outside investors, particularly if they're substantial, they'll ask for preferred stock. And preferred stock, it's all very specific to your arrangement, and your lawyers will help you negotiate that. But some of the common things are that decisions and voting rights on making major decisions, like when to sell the company, how much to sell the company for, and so on. And it also, I guess one of the most important things about preferred shareholders is if you had to, let's say, liquidate the company, they get their money first, and then for whatever is left, and then whatever's left over, then the common shareholders get. By the way, sorry if I neglected to say this earlier. Feel free to submit your questions along the way, and we'll be answering them at the end of the webinar. So I'd like to cast a poll here, and let me go ahead and pull this up. So I'd like to ask, how many people attending today's webinar have raised money before? And excuse me while I pull up the actual poll. Okay, great. So we're going to give you a few moments here to please cast your vote. Is that poll coming up there? You see the responses coming in? Okay, great. So we're going to give it another 5 seconds here. And all right, so let's go ahead and show the results. So it looks like about 60% of our attendees have never raised capital for your startup, and that's why you're here, which is great. And about 40% of you have. So very good. So thank you for that. So how long does it take to raise capital? It really depends, and I'd say get ready for at least 3 to 6 months if you're not using a platform like Onevest. Certainly is faster when you're using a platform like ours because you get introductions much quicker, and we do a lot to help market you. We send communications out to our investors. We hold digital demo days and so on. But if you're generally speaking, earlier stage rounds can take 3 to 6 months, and if you're raising like a Series A, which means you have outside institutional investors like VCs, and you're raising more than a couple $1 million, it's going to take you at least, I'd say, budget for like 6 months. It could take up to 9 months to do that, but I'd say 6 months is sort of on the safe side. So it depends on a lot of things, and it depends on what kind of financing. So I know it's hard to make out this chart, but I at least want to help you find it. It's called Anatomy of Seed, and it was by Oxford, put out by a guy named Brendan Baker. So you can just Google that and should show up. And so it depends on if you're going for VC funding, it's going to take longer. Seed takes a little bit shorter, and I'd say angel groups probably take by the time you apply, get screened, get to pitch, get an answer, that's a couple months as well. So hopefully that's a little bit that's helpful to lay out your runway a little bit. So before we start talking about best practices for raising outside capital, let's figure out if you even should be doing it. Not everybody here today should necessarily be raising outside capital. So let's talk about the good stuff. You can hire people faster, which means you can launch your product faster. You can execute on the business quicker. You can be experimenting with more things. So in startups, I think the whole startup is an experiment, and you got to get good at experimenting with different customer acquisition methods. And so rather than kind of sticking with one or two sure ways, you can begin dabbling into more sort of more things that aren't as predictable. So, and those are really great because that's stuff that your competition hasn't figured out, and they could end up being really cheap ways to acquire customers. So you always want to be experimenting, can be doing more of those. And I would say if you're also getting the benefit of having these experts come in, advisors who put in money are the ones who have the most to gain, and so you're getting their help and their support. The cons of raising outside investment is you're giving up equity, ownership, but as I always say, it's better to own a little bit of something than a lot of nothing. So with that money, you can increase the valuation of your company if you spend it wisely. You are diluting yourself and your current shareholders a little bit. Maybe add some friends and family, and you also have more people to answer to. So depending on how you arrange your relationship with your outside investors, they might require monthly updates. They might want to be a little bit more hands-on, where they're influencing your decisions. But it's all on how you set that expectation, whether you give them a board seat or not. But ultimately, you do have more people that you're accountable to. So, how do I decide how much to raise? One way is to figure out what are the key benchmarks that my business needs to hit. It might be, if we can get to, let's say, 100 customers or 1,000 customers, depending on the sort of your price tag. We need to get to this number of customers, or we need to get to profitability, or we need to get into 15 markets, whatever those are. And then if you can get to those, then you probably qualify for another round of funding. So maybe right now you're talking about your seed funding, and if you can get that and execute on these 3 or 4 milestones, then you'll have a good chance to qualify for a Series A funding. The other way to do it is just kind of figure out what plan you want to execute, and give yourself about 18 months of runway. You probably want to give yourself a little bit of wiggle room there, because nothing ever goes as planned, and things always take longer and more expensive than you hope for them. So you want to put in a little bit of buffer. But I would say raise enough to execute your plan for about 18 months, depending on your industry and your investors. And if you're San Francisco, you probably don't need to get to profitability as fast as you're on the East Coast. I feel like East Coast has just got a different kind of expectation, and you really just need to prove yourself and prove that there's a business there. So your investors have different appetites for profitability, but if that is one of them, you want to make sure that that you give yourself enough runway to reach profitability. So what are investors looking for when they're evaluating you? The more sophisticated the investor, the more deals they're looking at. So I think the number that I hear often is like a partner at a VC is probably looking at close to 300 deals a year, and then they sort of shortlist about 80 of them, and then they might invest in 8 or something like that. So it's a very this funnel is really kind of gets really narrow at the bottom, and so in the less sophisticated investors are seeing less deals, but I would think all of them would agree that the team is by far the number one thing that they're looking for. The younger the company, the more the team is important. So if you're already raised a Series A, they're looking at your business fundamentals. If you're just sort of a promise and a hope, they're looking more, does the team have what it takes? Do you have the right bench strength to execute a plan and be able to navigate the waters and make the informed decisions along the way? So if you don't, I would say if you're a single founder, go find a co-founder. If you're looking for outside investment, they're usually it's more of a exception that you're going to get outside investment into a single founder, especially if you're going to an accelerator. They practically don't even accept you as a single founder. And if you don't have one, go to cofounderslab.com and find yourself a co-founder. It's a great service. It's the biggest pool of founders that are looking to join up with you. There's events you can go to. We have about 12 events just next week all around the world. And then you can go online and find co-founders. So check out cofounderslab.com and do me a favor and purchase the pro membership if you do. because I'm a founder and I need to pay the bills. So we are moving on to the next topic here is idea. Is it a good idea? Does it solve a pain that is bad enough? I mean, I hear there's somebody was talking about something, he came up with an idea about, when he was getting a haircut, about how the salon could get better. And, I just think to myself, well, is that a big enough pain point that somebody's going to pull out their credit card and pay you to solve that problem? So that's what you need to really validate that idea. They're looking for the traction. Traction can mean many different things. Ideally, we're talking revenue, but if you don't have revenue, you could have some beta customers, free customers, and maybe it's how many people are subscribing to your newsletter. What's the social proof look like? What people are saying about you? How many partners you've lined up to join you in your mission of your startup? But ultimately, traction. I think the basics we're looking for is the number of users, how fleshed out the product is, and if you've got revenue, that's even better. How large is the market? If you are going to take outside investment, you really have to be able to show that you're you could potentially generate $50 million in revenue. If the market if you don't think that you can build a business and your share of the market can generate $50 million in revenue, it's going to be a little harder to get outside investment. And if you're talking to VCs, they got to believe that this can be like more in like $500 million is what they're generally kind of what they're looking for. So they're looking for really big concepts that can have $1 billion exit for them. And then they're looking at the competition. Is there competition? Good. That means there's a real market out there. If there's no competition, maybe you're either like totally crazy or you're really early. But either way, they're looking at competition and they want to see, are you way ahead of your competition or are you a laggard? Like, how are you going to ever catch up with the guys who've been doing this for like 3 or 4 years? Like, do you really want to go up against like QuickBooks, who's been around forever? And if you are, you better have a really good plan of attack as to why you're different and how you're going to acquire customers cheaper than they are. So you decide you're going to go out and you're ready to raise some outside capital. You got to get a pitch deck. So what's a good pitch deck look like? It breaks down into 3 parts. Your intro, and this is on the left of the slide, your introduction, the statistics, all the numbers, and then the financials. So you want to keep this pretty short, like 10, 15 slides is good. And you want to talk about the team, the overview, the solution that you provide, the pain you're solving, and how you solve that problem. Really straightforward, boil it down as concisely as you possibly can. Then we talk about the market size, who the competition is, and what your traction is. Sales numbers, users, followers, partnerships, and then your projections. What's your business model? You're putting in what's your customer acquisition cost? You're putting in, $50 to acquire a customer. Well, that customer's lifetime value needs to be more than $50, and not only for customer acquisition, but your operating costs. You add that stuff up, and you figure out, when can this thing become profitable, and then you ask how much you ask them for the amount of money that you're raising. So I am raising $750,000 for my startup. Would you be interested in being a lead investor, or would you be interested in putting in $50,000 or whatever you're asking them for? And then you got to tell them how you're going to be using the money. So that's the use of proceeds. We're going to be investing this money to put it into raising 5 engineers. We're going to be using it to be at these 25 conferences. We're going to be putting it into buying advertising. Whatever your implementation plan is needs to be spelled out there. So you raise money, now what do you do? And you've closed this round. You want to regularly communicate updates to your investors. I like to do it monthly, but quarterly I think is okay too. Focus on your milestones and just what do we need to get done this quarter, and how do we back into this month, this week, and today. And always be sort of what we call right to left thinking. So what's the objective for this capital to get us to our milestones, and kind of what's the implementation plan then you delegate it to your team and take on a big piece of it yourself. And you're always working on kind of long-term and short-term. It's just a skill you need to be able to get good at, doing both of those at the same time as a founder. When you get that money into the bank, you celebrate for a little bit, but not long, and you got to just get back to work. So we're gonna ask another poll here. So how familiar is our audience with the Jobs Act? There's the Title II and Title III of the Jobs Act, but in general, let's see how much time we should spend on this. We're going to give you another few seconds here. Please just click yes or no on the poll that's on your screen. And the majority of the people looks like we're going to go ahead and share the results here. So only a third of you, about less than a third, have heard about it. So what is the Jobs Act? There's lots of different parts of the Jobs Act. It was championed by President Obama and Steve Case, were the founder of AOL, and many others in Congress got behind this. And it has things to do with immigration laws and how do we get more people to help boost our economy. But the piece that we want to talk about today is the fundraising of the Jobs Act. So there's Title II of the Jobs Act that passed last September, which lifted I think it's like 70 or 80 year ban on publicly advertising that you're raising money for your startup. So it used to be that you could not advertise that you're raising money for your startup publicly. You could only get it if let's say you wanted to raise money from your friends or family, since let's say they're non-accredited, which means accredited definition by the SEC is you have over $200,000 in income per year, and you can prove it, or you have $1 million or more of liquid assets, meaning like you own shares of stocks that you can sell on the stock market. That does not include your primary residence. So you couldn't advertise that you were raising capital. It's like, sort of an insider's kind of club thing. So in September last year, they lifted that ban. So you could put a Facebook post that says I'm raising money for my startup, but you have to comply with the SEC, and you can only accept money from accredited investors once you begin publicly advertising. And that's what we're doing on Onevest, is we're one of your places. So you can send emails out, you can knock on doors, you can put flyers on people's cars that you're raising money. That last one's probably not very helpful, but as compared to going on Onevest, where we advertise you to a group of 15,000 investors and growing. So that's Title II. Title III is going to, we hope, it's still it hasn't been approved, but we're waiting on word from the SEC, and hopefully it's the next few months. They've been promising it for a little while, but that's how Washington is these days. And what that's going to do is allow you non-accredited investors to invest. So that's really huge, because right now there's only 8 million accredited investors in the United States. Let's just talk about the United States for today. There's 8 million accredited investors, but when Title III passes, all those millions of people that are watching Shark Tank that love new companies and they want to invest and they're not accredited, they can also invest in your startup that you are publicly advertising. So we're very excited about that development, and you can stay in touch with us. So we'll be keeping you posted if you're on our newsletters. So the Jobs Act really grows the pool in the United States from 8 million to 300 some million people. Well, maybe less, because people under 18 and people who just don't have disposable income aren't in that number, but it's certainly 10, 20, 30 times bigger pool. So the good thing about crowdfunding, you're going to advertise and you reach a larger pool of investors, because your personal network, especially if you're a first-time founder, it might be kind of small. Especially if you're younger, you haven't been out there networking, working at multiple jobs, going to events. So it saves you time. It just basically, we introduce you to investors. But there's no shortcut to raising capital. You still have to go through the very difficult process of convincing someone to invest in you. So this isn't like a magic bullet. It's not like you put up a post on Onevest and a profile on Onevest and people just start emailing you and saying, I want to put money in. Some do, but you have to reach out to them, and you have to go to events, and you really got to hustle. So the other thing, that the benefit of crowdfunding is that it used to be that you'd have to go get a smaller group of investors, which meant that they had to write bigger checks. So before when I first started, I had to go convince somebody to write a minimum of like $150,000. Well, that's a pretty big risk that they're taking. But with equity crowdfunding, you can convince someone to write a $10,000 check. So it's all about risk reward, right? So if the risk is really high, it becomes more difficult to make that transaction happen. If it's just like 10,000, 50,000, that's a lot less, particularly with accredited investors. They're already investing. They're investing in real estate. They're investing in the stock market, and this is just a new asset class. And as this becomes more mainstream, they're going to say, wait a minute, why I want to invest in the next Facebook, or I want to be in the next WhatsApp deal. So this is becoming more and more popular, and the way they think about it is they say, all right, I'm going to take 5 to 7% of my investable capital, and I'm going to put that into alternative assets. And so startup investing would be considered an alternative asset. It's higher risk, much higher risk, and so but they're willing to take maybe a piece of their portfolio and put it into startups, and so it's a smaller check. And so that's good for founders. So we really want to democratize access to capital, and that's what we do through the internet. Is you don't have to be in San Francisco or New York and Boston. I mean, I raised money here in Rockville, Maryland. We're right outside of D.C., but I was able to do that through crowdfunding, and I got investors in Hawaii and Boston and in New Jersey that I would have never otherwise found. But you still have to earn it. I mean, you have to be good enough to earn it, to get the money, but it really opens up the pool and saves you a lot of time in finding these investors. You don't have to wait 6 months to go to a half a dozen events and do your networking. You can just do it online. And what I really like is I've got a couple investors that I got through crowdfunding that are they're strategic. They can provide advice in your industry. They can make introductions. They can give you feedback on your product. They can introduce you to other investors. So more investors, more contacts, more value that they can bring. So with that, we're going to conclude the formal presentation and begin taking questions. I do want to, if you don't stay for the Q&A session, there's a great resource called learn.onevest. There's all kinds of content out there. One of the most popular pieces right there is a course that Adeo Rossi did from Founder. He's the founder of Founder Institute, and there's a video that talks about what we did here today. But there's all sorts of other good nuggets in there. Think of it like a Reddit for founders. So you can contribute content, you can vote content up and down, and we're going to be formally announcing it next week. But since you're part of our community, I want to give you a sneak peek at that. So check out learn.onevest. Keep up with us on Twitter. Sign up for our newsletter on onevest.com, and if you think you're fundable, you can apply, and we can help you raise your round using our equity crowdfunding platform at onevest.com. So let me go ahead and open it up for questions here. So our first question comes from John, who asks, what kind of return are investors seeking? All right, so the investors are looking for somewhere between, like, I'd say 7 to 10 times is the return that they're looking for in a startup, investing in a startup, and that should take you, like, if you're really lucky, 3 years. Probably, like, I'd say somewhere between 5 to 7 years is kind of what they're looking for on their return. Let's see, or the timeline. So the next question comes from Brian. who asks, what's the biggest risk associated with using convertible notes? I'd have to think about that. I really like convertible notes as an instrument. So let's see. I guess one potential risk. I'm guessing you're asking maybe from the investor's point of view. Well, it's for the investor. It's the same risk of just losing the money and you just never pay them back. So that's one big risk that the investor has. From a founder standpoint, it really depends on the terms that you negotiate. So I'm sorry, I'm not really doing a good job answering that. I'm going to move on to the next question here. Next question comes from Ryan, who asks, do you consider being listed on Onevest to be publicly soliciting? Yes, absolutely. We do have companies who are not publicly soliciting on Onevest, but I think to really get the value, you want to be publicly soliciting on Onevest. So I would say you ought to be to really get the big benefit out of Onevest, but you don't have to be. It's not a requirement. And there's a second part of that question. Okay. So the follow-up question part was that you help with SEC requirements for public solicitation. Yeah. So we help. We have a broker dealer that we work with called WealthForge, and so we make sure that the investor is accredited. So and then you want to make sure that you file with the SEC after you're done doing your 506 fundraising. And so yeah, we'll give you the information you need to make sure that you comply, and we'll also do so we also verify that the founder is not a bad actor check. We do all the checks on you to make sure that you can publicly solicit as approved by the SEC, and we also do the checks on the investor to make sure that you're in compliance with the SEC, that you are taking money from an accredited investor. So Eric asks, how are you different from AngelList and Gust? So AngelList, I would categorize. I mean, there's the geographic difference. I think AngelList seems to have taken a system that was working well in Silicon Valley and kind of brought it online. And they're really a directory. Anyone can get onto AngelList. Where the big difference with Onevest is we're a curated platform. So we do our due diligence. We have a very rigorous process to establish that you are fundable in order to bring you to our network of investors. So that's the biggest difference that Onevest has against AngelList. As far as Gust, Gust's a great company. I kind of consider them more like a back office software to angel groups. So I don't know. I personally don't have a lot of companies I know that have successfully raised on Gust, but their customers, their angel groups that use their software, certainly are a good place to go for raising capital. So these are angel groups that may be on Gust. So GD asks, is there such thing as return on investment crowdfunding where no equity is offered, only interest on money given? So there are lending platforms, like Lending Club is one, where you could issue you could give their money back plus interest, but that's not what we do. So we're an equity crowdfunding platform where you are either immediately issuing shares, or in the future you're going to issue shares through the convertible note. But yeah, there are crowdfunding platforms that have that allow you to do interest. Sorry, I'm trying to read the next question here. So Alan asks, what are some of the disadvantages of crowdfunding? I think one of them is that if you don't set a reasonable minimum that you're willing to deal with on the investment, you could get a lot of investors, and so unless you roll them into a SPV, a special purpose vehicle, You could have a lot of shareholders, and then every time you want to do like major decisions, you have to get approval from them. So that depends on the minimum that you set. So if you set, let's say, a $20,000 minimum or $10,000 minimum, maybe that's okay. So that's one thing that you want to. There's ways to guard against that, but that's one thing that you may be up against if you don't set a higher minimum or you don't use an SPV. So I think that's one. The other is that not everybody on the platform, the investor pool, is necessarily going to add value when you're doing equity crowdfunding. Where if you go to, let's say, institutional investors, they generally have something that they can offer as far as by way of advice and guidance. Where on equity crowdfunding, you're not guaranteed that everybody on there can offer something. So some people are just sort of, we call it dumb money. They just write you a check, and that's fine. But you probably do want to get some people that can add some value. I would advise against not having all dumb money. You want to have at least a couple people in the mix, and you'll be doing that crowd. You're not going to get 100% of your round done on our platform. We don't advertise that, and we don't necessarily recommend that. Maybe someday, but currently we're filling in your round. Some companies are getting half or more of their round, and other companies are getting, let's say, 20% of their round done on Onevest. So next question comes from John. Do you recommend setting limits on the investor for cashing out? I'm not sure I fully understand that question. I think it's saying that can you say, hey, investor, you cannot sell your shares out in, let's say, the private market. You know what? That's legal advice. I really would probably I think I'd refer you to your counsel, a lawyer that could help you with that. Let's go to the next question from Okay, there's a question that comes from Dalcine, who's asking, if you only have an idea, how can you get investors interested in investing in a great idea? Well, you're not going to be able to do that on Onevest and probably any crowdfunding. I don't think you're going to do that. You're generally looking for you would have raised money before you would have raised some money before you come to a platform like Onevest. But I think if you're going to just sell the idea, you're probably your best chances are friends and family, and they really have to believe in you as a person. But I think that's really tough to do. I don't know a lot of people that have been successful with that. I think you need to get out and start trying it. You got to put your butt on the line, your time, and talking with potential customers, doing customer development, validating the concept before you take money, even from family and friends, because that's really, really risky. So I would just strongly advise against taking money from investors with just the idea. You want to have some work done, validation, maybe a prototype out there. Jay asks, how important is the business plan versus the gut feel the investor have about your business? I think most investors, in fact, we did a webinar with Barbara Corcoran, who's one of the celebrities on Shark Tank, who happens to be an advisor to Onevest, and she basically really kind of threw out the whole business plan. They usually don't end up turning out the way that you predict. In fact, most startup, and I think many startup investments are happening just with the pitch deck. I mean, you want to show your financials, but like a full-on kind of thick business plan, I don't think is really necessary. But I think generally when you say gut feel, I'd say gut feel probably trumps the business plan, but the gut feel is informed by many things, like do they feel like do you have integrity? Are you someone they can trust? Is the market big enough? how do they feel about your traction? So I don't think the business plan is that important. Certainly, your pitch deck and fundamentals need to be strong. So Jason asks, I'm a single founder with no team, and I already have a couple $100,000 in revenue. I'm at a point where I see outside investment being a great strength to show the business. Could I find a co-founder before searching for investors? Should I find a co-founder before searching for investors? Yeah, I think you're going to be more investable with your co-founder. So I would say absolutely begin your co-founder search, and just sort of, you might kind of do some light prospecting out there, especially since you've got revenue. So nice job on that. But maybe kind of do it a little bit sort of half speed, if you will, but then really commit to your fundraising campaign once you find a solid co-founder on cofounderslab.com. Ria asks, can non-American companies raise funds through Onevest? She's across the pond in the UK. So unfortunately today we do not accept companies outside of the United States to raise money. We certainly take investors overseas, but we do hope to offer international companies to raise money on Onevest, just not today. On onevest.com, there is a resource link at the very bottom of the website, and so some of the questions about Onevest you'll find specific to Onevest, you'll find there as well. Brandon asks, are there good references or guidelines for allocating equity for early partners or employees in a startup? So we have some materials in the resource center under member benefits on cofounderslab.com. I think there's some articles on learn.onevest, but I think my favorite source reference on this is Slicing Pie. Hey, I happen to have it right here on my bookshelf. Slicing Pie, great book. You can go online. There's some free stuff that they have there. But basically what this book says by this professor, Mike Moyer, is that your equity should be commensurate with the value that you're bringing. So, for example, you could, if you're bringing, business contacts or potential investors or customers, that has some value, and this concept, Slicing Pie, helps you ascribe a value to that. Your time is some value, so you take sort of what you're earning out in the market. Let's say you're making $50,000, maybe discount that by like 30% because you don't get fair market when you're working at a startup. So let's say sort of per year you're putting in, let's say, $35,000 per year, and then whatever the valuation of the company is, you would basically say my time here is worth X% of the company. So those are a couple just tactical things to illustrate the answer. But yeah, to answer your question, I would say Slicing Pie is a great resource for that. From PD, who asks, do angels expect that almost all seed funds go towards development of product, or can you use capital for office space, marketing staff, etc.? Yeah, absolutely. It's it's not the case that angel investors expect that the money be used just to build your product. It is certainly fine to use it to rent space and hire marketing, do marketing. It's really to implement your plan, your execution plan on your company. Seta asks, what's the application process like for Onevest? Well, you would submit you create a profile on Onevest. At that point, we'll collect some additional information from you, and one of our analysts will review your application, and then if you meet the criteria, we'll get back with you and get you into our onboarding process, where we create your campaign, give you some tips, and begin advertising you to our investors. A few really basic criteria, just to know if you should go through the trouble of drilling down into this. We're looking for companies that have raised some money before let's call it 20-25% at least of the round that you're trying to raise right now. So if you're raising $1 million, you should have raised 200,000 before you come to the platform, and at least 2 people working full time on the business with some traction. Typically, by traction, we're talking about some users, ideally some revenue-paying customers is even better. But we do have some companies who have not began charging for their service yet, so that's okay too. Andrew asks, what impact does crowdfunding have on future institutional investments? This is a pretty common question, and it depends on the institutional investor. I think I've heard some institutional investors think like, well, it's sort of like a black mark. It's like, well, why did you have to go to crowdfunding? Why couldn't you raise it on your own? I think that's becoming less of an issue as equity crowdfunding is becoming more popular. It comes down to the terms that you offer to the investors. So whether you did it through equity crowdfunding or not, it really comes down to the terms that you offered them, so they can, that the future or the VC can sort of sit on top of the previous investor, which they always do in every sense of it. But the other way to look at it is, and how I would look at it is, I want to invest in a founder who is resourceful and scrappy and is efficient and is always looking for the shortcut to get the same result. And if you're smart enough to join this webinar and you're considering going on equity crowdfunding to spend 2 months instead of 9 months to raise capital, that's a good indicator. I like that as an investor. So we could argue both sides of that. Amir asks, can I use more than one funding website in raising funds? It depends on who we generally do ask that you're only raising on our site, but there's certainly exceptions out there. We just want to know about it. So each provider is going to have a different term on that, but we do on a case-by-case basis. Again, if you inform us, allow you to do that. Naveen asks, when is a better idea to start approaching VCs? When you have your prototype ready, or when it is in the market? If you're talking about VCs, it's got to be in the market. They're not going to invest I mean, it's very rare they're going to invest in a prototype unless you're like the founder of Intuit or something. You're not. I mean, you really you're like a rock star, reputable founder. And even then, I think it's a long shot. So yeah, the short answer is after you're in market. Sean asks, do investors invest in businesses or in people? What is the ideal founder team size? Like I said earlier, the younger the company is, the more it depends on the team. So there, David Cohen from Techstars says, it's team, then market and traction. So it's really about the team. What's the ideal size of the founding team? 2 to 3 people, I think, is the ideal size. I think I've been in teams that's 4. It comes with some challenges. Sometimes you get you get in some gridlock when you have 2 and 2. You don't have a tiebreaker. Sometimes decisions can take a little bit longer to make. So I'd say ideally your founding team is 2 or 3 people. Boyd asks, do you need a financial projection to get funding? Yes, you will need projections. You need to say how much revenue you're gonna generate, by when, and what your cost model is. So you absolutely need that. We're gonna take one last question, and then we want to be respectful to everyone's time. Thank you very much for spending the hour with us. The last question comes from Vulcan, who asks, how long does it take on average to raise capital on Onevest, and the average amount of capital roughly? So we're seeing the raises is around 750,000. It's like a $750,000 round, but that gets averaged because some companies are raising a couple million, and some are raising 300,000 or 400,000. I'd say it's sort of at least 300 or 400,000. And how long does it take? It could take as short as a few weeks, a month, and it could take up to let's call it around 6 months. Around 6 months, actually, if you're not able to raise money, I think it's by 6 months, we actually remove you from the platform. So there's probably something else going on or wrong with the business, and you want to kind of go back to the drawing board and address the concerns that the investors have been telling you, which is great learning experience. And you go back and you say, hey, if I move this around, or if we kind of get further along in the business, maybe you can come back and be more prepared then. So again, thank you very much for joining today's webinar. Check out learn.onevest. Please apply to OneVest if you believe you meet the criteria we talked about, and you can also find on our resources section. And congratulations on the journey you've taken as a founder. It's one of the most rewarding and toughest, but we wish you luck in building your company and creating jobs and realizing your dreams. Again, thank you for joining OneVest today, and we hope to see you again soon.